Thanks for joining us for today's webinar. What's in the rearview mirror might be closer than it appears, 2025 year-end planning. My name is David Blain. I'm a partner and director of McKonly Asbury's Entrepreneurial Accounting Solutions, or EAS group. And joining me today is partner and EAS leader Lindsay Young and tax senior manager Zach McLaren. Zach and Lindsay, why don't you say hello?
Good afternoon.
Hi, everyone.
Good. If you're not familiar with us, McKonly Asbury is an accounting and business advisory firm with offices in Camp Hill, Lancaster, Bloomsburg, and Philadelphia, Pennsylvania. We offer a wide range of services to organizations in various industries, as you can see on the list there. For more information, please visit our website at www.macpas.com. If you joined us on past webinars, welcome back. If you haven't, our monthly webinars feature various business topics to keep you updated on what's going on around us. Be sure to check out our website to catch past presentations, as well as current information through our blogs. Our thought leadership subscription, M&A Insights, has been revised to give our subscribers an opportunity to select which topics are most relevant for them. Subscribe today to stay informed. So again, we have a number of different industries that you can subscribe to, and we would recommend that you definitely go in there to macpas.com and find the industry that is most relevant to you and get that thought leadership that's sent out on a pretty regular basis. So, all right, so we're going to be going over a couple things here today. Our key for today's session is going to be, getting started now on year-end planning, whether it's for financial statement purposes or for tax purposes. We're going to be talking about a proactive approach to this. That's why we're having this webinar here at the end of October. So we are working with our clients, and you as individuals that are out there are really working towards making sure that you're well positioned going into year-end. And the focus areas, again, are going to be internal financial statements, tax planning under the new, well, I wouldn't call it the new tax act. A lot of it's just making a lot of changes from 2017 permanent, but we'll talk about what that means to you as a business owner, and the long-term financial health, things that we want to focus on going into 2026. So keep in mind that we will have a CPE questions popping up throughout the presentation. So the key here is to make sure you're paying attention as the CPE questions are coming up, because I'm pretty sure there's a lot of people here that are probably interested in making sure that they're getting their CPE. So if you have any, just make sure that as the CPE questions are coming up, you are paying attention to them, because you'll need to answer the polling questions as they become available. So again, for those of you who are looking for CPE for today's webinar, please keep in mind that there will be 4 polling questions throughout today's presentation, and you must answer all 4 of those questions to get your certificate via email within a month after the webinar. So in order for attendees to be eligible, you must answer them via the polling submission, and we will not accept late responses. So again, we will prime you when it's time to make sure that you get your CPE, because I'm sure everybody's here mostly for CPE, but also for the great content that you're going to get. So again, the objectives: address internal financial statement matters before year end, understand 2025 tax initiatives under the OBBBA, or that one big beautiful bill, and build a framework for consistent organizational financial health reviews in 26. All right, so let's go to polling question number 1. Everybody making sure we're paying attention here. Do you wish to receive CPE for today or not? So we'll give you about 60 seconds to answer this, yes or no. So. Everybody's getting ready to answer that polling question or finalizing that polling question. I would just say to Zach and Lindsay, are you ready to go? Are you excited about this webinar?
I'm excited, Dave. I'm glad to be here today.
Lindsay's coming off minimal sleep as she had to make a flight across the country to get back here just for this webinar. So Lindsay, that's dedication.
Thanks, Dave. I appreciate that.
All right, so 86% are here for CPE, and 14% are not. So that's actually interesting. You know, so good. There's some people on this that are really looking forward to the content and the information that we'll be able to provide on year-end planning. So
awesome, Dave. Go ahead.
Let's go ahead and get started. Lindsay, I'll turn it over to you to start talking about a case for early year-end planning.
Thanks, Dave. I'm excited as we start to look towards December 31st, but ultimately when we start talking to our clients on or around that time frame, it just becomes too late to make effective changes. So we're going to look at it from a strategic standpoint where when you give leadership more time to analyze trends, identify opportunities, and kind of make some informed strategic moves, it allows us to become more proactive and make better decisions instead of just reacting to the changes or what we're seeing when we're so close to year end. Ultimately, we are talking about maybe looking at different scenarios. When time is on our side, we can run what if analysis, we can make investments, we can fund retirement plans, make hiring or purchasing decisions, and really start to make paths rather than scrambling under pressure. We can also be really aligned with business goals and kind of focus our financial strategy to support organizational objectives, maybe geared towards growth, sustainability, or maybe just capital improvements for the business. Early preparation leads to just generally cleaner financial statements, something that's more effective. It allows us to work with our tax team for better strategy and just reduce errors and rework. When we're kind of rushing into year-end closes, it often leads to mistakes. And when we start early, it allows us for reconciliation, cleanup, the ability to implement review processes, and just generally improve our accuracy. Often when we are proactive, we see smoother audits, smoother compliance. We even, in fact, have improved cash flow management. It kind of gives us an insight into receivables, our payables, kind of being able to look at some spending patterns and just generally make sure that we are allocating our time and our resources to where they should be. From a forward-looking perspective, we can start to see, and Dave will get into this later in the presentation, just allowing the data to drive planning for next year. We're looking at year-end data, we're doing better budgeting, better forecasting. We're starting to leverage the technology that's at our fingertips and really just start talking about tax optimization, which you'll hear from Zach about in a little while.
Lindsay, quick question for you. How often do you see clients that they just pop up out of nowhere at the very end of the year and say, you know, on the 28th of December, hey, can we get together and talk about tax planning, financial statement planning at the end of the year? How often do you see that?
More often than I probably care to admit to, Dave, but those sometimes can lead to good conversations. But sometimes we're trying to make decisions in the 11th hour and we can't get the funding we need, or maybe that vehicle is no longer on the lot because we waited too long. So I can't encourage it enough, and we see it often, and we're really trying to set ourselves up for success for the future.
Absolutely, that's the whole intent here, right? Try to set it, you know, better planning towards year end to give you a better opportunities for tax and cash flow management. So,
agreed.
Okay.
So we're going to dive into a little bit of what I'll call the meat and potatoes here for internal financial statements. If you know me, you know a balance sheet is just about one of my favorite things. And by the way, I'm just going to give a shout out back to Dave. Cash is still king. We want to be reviewing the cash reconciliations at the end of the year, making sure we are reconciled, that old and outstanding or stale items have been appropriately addressed. we're going to reconcile all of those other key accounts as well. Your credit cards, your payables, your receivables. We're going to verify payroll, posting of benefits, especially 401k, health, bonuses. We're really going to take the opportunity to tie down and really make sure that our balance sheet is really talking about our position financially. We want to make sure that we're looking at our financials from the aspect of what assets did we purchase this year? Have there been disposals that should be noted? Are there updates needed to our fixed asset schedules? And are we adhering to our capitalization policies? More often than not, we see very small purchases, which really should be directly expensed through the profit and loss statement, being added to fixed asset schedules. And really, we just want to make sure that we're giving good financial data throughout, so it can allow us to do great tax projections. And when we're making those large adjustments at the end of year, it just really skews projections we may have completed. We want to be checking our accounts receivable for collectability issues. If we have implemented the credit loss or expected credit loss standard, we want to make sure we're making any adjustments for bad debt. We want to make sure we're adhering to our policy. We want to make sure that we're looking at our prepaids and updating our schedules on a regular basis. Booking those year-end accruals. Do we have a new lease that needs to be entered into the lease schedule? Are we tracking the appropriate debt? Are we booking interest? You'd be amazed at how many times we start to see clients' financial statements and we log in and there's negative cash, or there's negative loans or lines of credit. And it's about education and talking to them and making sure we're recording payments appropriately, we're breaking out interest, we're tying into those documents you're getting at the end of the year. So those key account reconciliations just continue to be just really epic when you're thinking about your financial statements and making sure. We want to make sure we're also taking a look at that equity section. We are not lost in changes that you've made. Maybe you've brought on new partners, maybe there's been a sale of ownership. Are your distributions equal for S Corps? It's a conversation we're having pretty regularly with clients to make sure we're also closing out prior year equity and that the equity section makes sense for what has happened throughout the year. From a tax form standpoint, we are really working hard to tie into the various tax forms that are issued throughout the year. So 1099s, maybe you have a rental property. We want to make sure that rental income is tying to what is reported on the 1099. Same thing with 1098s, reporting for mortgage interest, or even 1099Ks, showing the volume of transactions you've done through a third-party payment processor. And of course, we're tying into Form W-2s and W-3s. We're looking at charitable donations on the profit and loss statement, making sure they are for applicable 501c3 organizations. And just generally taking the opportunity to review overall just general categorization of vendors within the appropriate chart of accounts. We sometimes will hone in a lot on repairs and maintenance, making sure that repairs and maintenance truly are fixing of the property, and we're not hiding new fixed assets in there. We're making a rundown through the meals accounts, making sure that appropriately allocated meals are there and entertainment expenses are broken out and tracked separately. And then we're looking for those large holiday gatherings or large events that you're doing that might have 100% deductibility and should be tracked separately. So we want to make sure we're having good conversation surrounding that. And then I would say one of the other key areas that we're also looking at is just reviewing expenses for various vehicles. Do we have an established policy on file, and are we following it? So we want to make sure those vehicles are on the books if they are 100% business used. We want to make sure they are insured by the business, that they are registered in a business. And if they are not, should we be considering another method? And maybe Zach will get into some of this when we talk taxes. But we want to make sure that if you have a policy, and if it's a mileage policy, that is great. Let's make sure we're following it, adhering to it. And we are also booking out-of-pocket expenses. Are there items that you have incurred that you forgot to use your business credit card for, or that really should have been on the business that didn't get there? So let's make sure we're having a conversation about those. And then lastly, just really reviewing those month-over-month changes. Are we missing items? Are there large variances that we should be looking at or reviewing against our budget? So we spend a lot of time in that checklist area, ticking and tying things out. But we also spend a lot of time on the 1099 reporting side of things. I would argue, and my team, I hope, chuckles at this, but we generally do 1099 reporting better than most. We really understand who the applicable vendors are. We want to make sure our clients establish best practices, that we are requesting W-9s prior to the end of the year. That W-9 form really is the precursor form to creating and issuing an appropriate 1099 to an applicable vendor. And you hear me say the word applicable. There's this stigma in the marketplace that it's only for these three types of things. But in reality, if you are an appropriate type of an entity, an LLC, a partnership, an individual, you may have vendors out there who you don't realize qualify. And that's where you really should be consulting with your accountant to make sure they're appropriately filing those 1099 forms. We are taking a look at vendors. We like to look at them on a quarterly basis, review those new vendors, make sure we get W-9s from them, and then review those W-9s to see whether they are eligible and if we should be issuing a 1099 at the end of the year. Generally speaking, you should be reviewing your forms and getting updated W-9 forms on file. We usually do a 4-year retention here from the date of filing to make sure that we get updated forms on file for any of our clients, especially if their address changes, or maybe they have a known business adjustment, or maybe they got bought out, or maybe they purchased a new entity and may have changed. So it's a good practice to kind of have that good communication. We often get the question too of what happens when someone refuses to send them and you know that they're applicable. We generally make 3 attempts. We try to contact the vendor, preferably by email, and retain said documentation. But if we're unsuccessful, you really should start and review the backup withholding requirements that the IRS provides as part of those guidelines. If you're using the QuickBooks software, there's some really helpful mapping features where you can map your chart of accounts directly to the appropriate categories for issuing of said 1099s. If you would like some instruction on how to do that, our team would be more than happy to share. But we really work hard to make sure that those are applicably mapped and set up appropriate to help drive the efficiency of the 1099 reporting policy. Back to kind of who qualifies, you want to be kind of honing in on rents that are paid, royalties that are paid, maybe interest paid on a loan to an individual that might be aiding or funding your business. But you want to kind of think about it from the aspect of, are they providing me a service? Services kind of provided in that course of natural trade or business, think kind of casual labor. Are they providing cleaning services, marketing services, website, other kind of computer services, or are they just a casual labor employee that helps on a trade show or a weekend? And should they really be issued a form? The threshold right now still remains that $600 for 2025, but that threshold will be increasing up to $2,000 for the year 2026. So that is a notable change that you will kind of see. If on a W-9 form, when you are reviewing them, if someone checks a corporation or they check an S corporation, in general, those things do not qualify for the reporting of 1099s. But again, you really need to understand the reporting requirements. So if those are legal services in nature, we would still be reporting. So we do want to be sensitive there. Document.
Lindsay,
Yep.
quick question for you. Just in regards to W-9s, you know, how frequently, you know, should a business request W-9s? You know, I mean, and how, like, to update them, you know, get updated W-9s.
Updated W-9s generally every 3 years. We're suggesting that you get updated ones on file. Those would document your changes to business structure, maybe new addresses or other key changes. I would say a general upfront best case policy is when you start working with a new vendor, at that time that relationship kicks off, it's kind of synonymous with thank you for working with us. And oh, by the way, in order to get your first payment, we're going to need a W-9 on file. I can highlight a star client for you that has one of those 3-ring binders, A through Z. If you are on this webinar, you know who you are. And every last vendor is tucked in alphabetical order. If you want paid, you're really simply going to return a W-9. It's just a part of their process. We can look at them, we can review them, we can update them, and we can make sure that we're timely reporting at the end of the year.
Awesome.
From the threshold section of the 1099 reporting slide, I do just want to kind of highlight those third-party processors, whether it's a PayPal, a Venmo, an eBay, Stripe. All of our favorite third-party merchants are using them. They often hide their forms in their portals. So you're not necessarily getting you're getting maybe an electronic notification of it, but you're not actually getting the hard copy form delivered to your mailbox or just flat out in your email. So you have to go looking for it in the portal, and those are important. The reason they're important is because if you've had more than $20,000 worth of payments through any one of those platforms or 200 transactions, they're issuing that tax form to you. And we want to make sure that your gross revenue is at least meeting or exceeding that. Things like merchant fees come into play, and some people will only report net transactions in their profit and loss statement. And then we're booking those merchant service fees as a one-time journal entry at the end of the year. Similarly, if you have refunds for activities you might be offering and they got canceled and we have to send a refund, those refunds aren't coming through unless you're physically looking at the daily transaction ledgers that are being printed in the actual software. So at the end of the year, we're looking at, okay, how much revenue was reported, and we might be, in this case, booking an adjustment for refunds that were processed for an event that we held or something to make sure that we're reporting gross. I understand that's just moving things from one bucket to the next, but it really is about tying into that form at the end of the year. So if you are processing through that third-party app, and you've processed more than 20,000 or over 200 transactions, you really want to be looking for that 1099K form in your portal at the end of the year. Moving along, practical next steps. We see so many times where the implementation of just a month end, a quarter end, a year end checklist should be done immediately. It really holds the team accountable. It drives timely and accurate financial statements. It's something that helps your team adhere to a closed process and a schedule. Get those adjustments booked. Coming into year end, if you have payroll adjustments, journal entries that are needed to those reconciled key accounts. If you have an S Corp and you need to call in and get your 2% shareholder, call and book those adjustments. Get them on a calendar appointment. Issue those 1099 forms. We can't talk enough about making sure you get those issued. And then on the flip side, when you're the recipient of all those forms, let's tie out those tax forms back into your financial statements. Tie your payroll back out to your W-2s, to your W-3. Make sure you're printing that year-end payroll summary report and tying it back into your financial statements. And then lastly, I would say schedule those tax meetings as we start to think about OB3 and how kind of it just generally affects things. The goal here really is to review financial statements from that 9 or 10th month close point and reaching out, making the connection, understanding what your tax liability is. Allow yourself the time to invest in equipment or next steps that give you that line of sight that you're looking for planning, budgeting, and then Dave is going to drive us home at the very end on why that is important as a foundational place for 2026 budget preparation. So get those checklists set up, book those adjustments, get on your tax advisor's schedule and plan those tax meetings so we can really set ourselves up for 2026 financial success. I think that might lead us into polling question number 2, Dave.
Yeah, I think so, Lindsay. Nice job. And so the next polling question here is, for which reason are you joining today's webinar? For CPE credit, tips and tricks to improve your year-end reporting process, changes in the 1099 reporting, tax law matters to consider for year-end, or all of the above? So we'll give everybody about 45 seconds to answer this question. So Zach, as everybody's answering this question, are you ready? Are you ready to follow that lead that Lindsay just kind of set the stage for?
I don't know if I can follow that, Dave. Lindsay,
I know, seriously, I got to be honest with you, Lindsay. Like, you knocked that right out of the park. Great job. So.
Thank you. I appreciate that.
But you know what, though? I know Zach's up for the challenge. So let's see what Zach's got to offer here when we talk about OB3. All right. So 25% for CPE credit, tips and tricks 4%, 60% all the above. See, we got 60% for all the above because Lindsay just came with her A game and just presented tremendous information about year-end planning. So Zach, I'll let you take it over on tax law changes with OB3.
All right, yeah, so tax law changes of the One Big Beautiful Act. This bill has had many acronyms, so today we are going to use OB3. I'm not saying it's my favorite, but it is the easiest to say, so we're going to stick with that. So yeah, it was signed into the bill was signed into law on July 4th, 2025, and essentially it just prevented the reversion back to the Tax Cuts and Jobs Act and many of the expiration of many of those provisions. As Dave said, there's nothing really too groundbreaking through the whole entire thing. A lot of it is the extension of previous provisions. So as we go through this today, we're going to want to take a special look at the effective dates. There are quite a few that have varying effective dates for the provisions. And then looking forward, we're going to make sure, just for planning purposes, that we're taking note of if the provision is temporary or if it's permanent. And a temporary provision is one that's designed to expire at some time here in the near future, and permanent one would take an act of Congress to change. So moving along, the first thing we're going to take a look at is going to be depreciation. So we'll start with bonus, and bonus depreciation is simply just an accelerated method of depreciation where you take a percentage of the asset in the first year, and that percentage has changed over time. Bonus depreciation has been around for years, and the percentages have been 100%, 60%, 50%. And if we look back at the Tax Cuts and Jobs Act, it was originally at 100%, and it was scheduled to decline 20% each year until we hit 2027, in which it was to go to zero. So with OB3, this is just restoring it back to the 100%. And here we have our first first set of dates that are important to pay attention to. And that's going to be January 19th of 2025. So assets acquired after that date are going to qualify for the 100%. Assets acquired before January 20th is going to revert back to that 40% rate from the Tax Cuts and Jobs Act.
Zach, quick question for you. Just out of curiosity, why the dates? Why not just set the date that the tax law was signed on July 4th? Any insight on that?
So Dave, that's a great question. And if you remember back and with the Tax Cuts and Jobs Act, which was signed back in 2017, the dates were sometime in September. And I really think they just like to make it difficult for us.
You think?
I think so. I really do. But so yeah, this was made permanent. This 100% raise is going to be made permanent going forward. So take an act out of Congress to change that 100% rate. Then also there's a key distinction with bonus depreciation when we're comparing it to Section 179, which we'll get into later, in that it can generate a tax loss. So if you have $25,000 profit before depreciation and you buy a $100,000 asset during the year, you're going to be able to take a $75,000 loss, the 25 minus the 100, against other income, so your W-2s, your interest, dividends, etc. So that's one kind of key distinction and benefit of bonus depreciation. And then lastly, on bonus, it's not allowed for Pennsylvania purposes. So you're going to either have to depreciate the asset over 5 years, 7 years, 15, 20, whatever it may be, the actual maker's depreciation would be. All right, so new this year is something called Section 168N, or 100% expensing for certain structures. So this, in the past, non-residential buildings were required to be depreciated for 39 years. 168N is allowing for 100% depreciation of those buildings. However, before you go and call your commercial builder to go construct a new building, this only applies to select activities and select properties. So those select activities are called qualified production activities, and they're manufacturing, production, refining activities. And then within that, you have to have qualified production property, and that is going to be property that specifically relates to the production or to the qualified production activity. So it excludes specifically office space, administrative spaces, parking, anything that's really not designated for that production activity. So there really isn't as many qualifying properties as what people are going to think from this. It's going to be limited to a very select group of people, but to those people, this is going to be a big deal. And then for construction period, so construction has to start after January 19th and before of 2025 and before January 1 of 2029. And then for the building to be placed in service, so construction has to be completed but after that same date, January 19th, 2025, but before January 1st of 2031. So it gives you a 2-year buffer. Then moving on to Section 179. So Section 179 allows you to expense up to 100% of the asset in the year that's placed in service. And I say up to because it can be, you can pick a number as long as it's not greater than the cost of the asset. This has been around longer than bonus depreciation. This has been around a long, long time. And the major changes out of OB3 is that the increased limits for expensing and for the phase out threshold. So for expensing purposes, it's up almost double. It was 1.22 million, now it's at 2.5. And then for the phase out limits, we're looking at a $1 million increase up from 3. As we talked about on the last slide, Section 179 cannot create any losses. So if you have that same situation with a $25,000 profit where before depreciation and you have a $100,000 asset purchase during the year, you're only going to be able to deduct the 25,000 to get it down to 0. You won't be able to take the full amount. That you can depreciate the full amount. It's just that it's going to sit there and be suspended and carry forward until a future tax year.
So Zach, basically that's the big difference between bonus depreciation and section 179 is the ability to take a tax loss.
Correct. And for Pennsylvania purposes, section 179 will be allowed. So that's new back in 2022, I believe the year was, or years after 2022. So it's you're looking at that 3% difference for purposes. But yeah, the big difference is that tax loss and being able to offset other income with it.
Excellent. Okay.
And then moving on. So we have this chart here, just kind of a quick visual to show the differences between the three. Bonus and 168K are they're the same thing. And what I really want to point out here is that I forgot to mention in the previous slides is there is an election requirement to use some of these. So for bonus, you actually have to elect out of it. It's a mandatory requirement that you use bonus depreciation unless you elect out of it, which you have to elect out on a per year or per category basis. So 5-year property, 7-year property, you can't pick and choose in between. And then for 168N and section 179, you must elect to use both of those. And then
quick question for you there, Zach. There's a question came in here about PA and whether whether you can also carry unused 179 forward for Pennsylvania purposes.
Yes, you can. So for both federal and Pennsylvania purposes, you can carry section 179 forward. Pennsylvania doesn't have a great form for it, so it's kind of a manual thing. At least they didn't in 2024. I would have to look at the 2025 things, but 2020, they do both carry forward.
Okay.
All right, and then moving on to section 199A deductions, or better known as QBI deductions. These were introduced as part of the Tax Cuts and Jobs Act to replace the domestic production activities deductions, the DPAD deductions. And it's just it's a 20% deduction that's based on your taxable income from the business. The business must be a partnership or an S corp or Schedule C. The Schedule E's can qualify, but you have to have certain requirements for that. And really the big changes that came out of OB3 for this is that it was made permanent and that the phase-in thresholds increased and have been indexed for inflation. Other than that, there's really not much that has changed in this area. There's still a much quicker phase out for those specified service trades and businesses, those SSTBs, which people refer to them as, and that's for lawyers, doctors, and accountants, athletes, those services that are based on an individual more so than a product or a business as a whole. So other than that, there's not really much here in this section as far as OB3 goes, but just wanted to mention that it is in fact permanent, and we should see this for the foreseeable future.
Yeah, and Zach, this is probably of everything in that bill. This is probably for business owners that are partnerships and S corporations or small entities. This is probably maybe one of the biggest parts of the whole bill is making this permanent, because that phase out, that 20% could have been significant for a lot of small business owners.
Yeah, especially when that deduction can be sizable for a lot of people.
Yep.
So if that would have went away at the end of 2025, that would have been a big impact to a lot of business owners.
Right.
All right, then just some other notable changes from OB3. So the business interest deduction limitation that's been around for a while, but what actually changed here is the calculation of it. And for those that aren't familiar with this, if you have over $31 million in gross receipts over the past 3 years, an average, your interest expenses is going to be limited. And into this calculation, they removed back a few years ago depreciation and amortization. Well, OB3 took it back to the original, which is an add back of depreciation, amortization to what is called adjusted taxable income, which is the base for the calculation. And without getting too much into the mechanics of all of this, this is ultimately a good thing and should allow for greater interest deduction. Then moving forward to R&D expensing. So looking back again to the Tax Cuts and Jobs Act, 100% expensing of R&D cost was allowed up until 2022. And at that point, R&D costs then were required to be capitalized and amortized over 5 years. So OB3 is just reinstating that expensing allowance to be 100%. However, for foreign R&D costs, they still have to be amortized over a period of 15 years.
Yeah, this R&D expensing being restored, that was a little bit of a tricky situation from 2022 to the current period as well. As I know, as a firm, we've had a number of clients that were taking advantage of the R&D up until 2022, and then that was a big impact to go from being able to expense to amortizing that R&D over the 5 years or whatever the period needed to be expensed. So reinstating this is really kind of a big thing for a lot of our clients, or at least some of our clients that can take the advantage of it.
Yeah, absolutely. And if you recall, Dave, it was there wasn't a whole lot of publicity about it in 2022 when it was a temporary provision for the Tax Cuts and Jobs Act, and it just lapsed, and not a lot of publicity about it, and a lot of people ended up surprised that if they were taking R&D that they weren't entitled to those 100% upfront deductions.
Exactly. Yep.
Yeah, looking at the SALT deduction then, so this is heavily focused on the individual side, but it will directly impact whether businesses are making pass-through entity tax elections, PT elections at the entity level. So just kind of a little bit of background on the SALT cap. Previously, it was limited to $10,000, and businesses filing in multiple states were tending to pay a lot of taxes to those states and weren't able to. They were getting passed through to the individual, which ultimately meant that their tax deduction was limited to $10,000. Well, states started to implement something called PTE elections to circumvent that cap, and you make it at the end of the entity level, and you get to deduct the taxes on the business return and not pass them through necessarily to the individual at that on a Schedule A deduction. So with the signing of OB3, this cap is actually increased to $40,000. So for many people, PT elections may not be as valuable as they once were, especially if you're below the phase out of the $500,000. So it's going to require a little bit of analysis if it's worth making the PT elections, or if you just want to forego those and take the deduction on the individual level as a Schedule A itemized deduction. All right, and then moving on. So here's just a quick summary of the effective dates of the provisions and whether they're permanent or temporary, the ones that we went over. Most of them that we went over are going to be effective as of 1/1/2025, and a lot of them are in fact going to be permanent. So.
Hey, Zach, there's a question that came in regarding prior year. Can you go back and amend to expense R&D credits?
So that's something we've been talking about. I'm not 100% sure if it's allowed yet or not, but there's the potential for it. So I don't want to give a definitive answer because I'm not 100% sure, and I believe there is going to be the potential for that.
Something maybe we can check back on a future blog article for.
Yep.
Exactly.
Thank you.
All right, and then just some year-end items to consider. Purchasing depreciable assets, capital assets. Given the changes to depreciation with bonus, and this is going to be a more attractive than it has been in the past couple of years since bonus depreciation had been declining. However, this doesn't just give you the go ahead to go out and buy a bunch of large expenditures. This should really only be done if you need the asset, you're going to purchase it in the near future, and you're financially responsible to do so. So, I mean, just remember that you're only getting a marginal tax savings for what is going to be a large cash outlay or a heavy financing agreement. And as Dave and Lindsay have both said, cash is king. So just moving on to segregation studies, this is kind of in the same vein. If you purchased real estate in the past years, it might be worth doing a cost seg. These are cost segs look at the building and its components. So if you have certain components of the building that are 5-year assets, 7-year assets, 10-year assets, you can essentially get a cost seg done and break those out, and then they would qualify for quicker depreciation methods or even bonus depreciation in that first year. PT elections, we just kind of spoke about, but if you're doing business in multiple states and have significant earnings, it's maybe worth your while to have that PTE analysis done. It could be some large tax savings there. Yeah. Retirement contributions, this is kind of the low-hanging fruit for saving taxes by year end. It's easy to do. Usually the plan's already set up, and it's just really just making a matter of making a contribution. And depending on what type of plan you have, if you're a business owner, you may have up until the due date of the tax return to make that contribution. And then lastly, estate planning. This is really no longer as pressing as it once was, since with the passing of OB3, the basic exclusion isn't going to sunset down to the $5 and $6 million range. It's now actually increased to $15 million for 2026. But with that said, it's really never too early to start estate planning. So with that being said, I will
before we get to that third polling question, a real quick question for you, Zach, that popped in here. The question is it correct that you can deduct the remaining R&D costs that were capitalized on the 2025 return?
Well, this should apply to the 2025 tax year. So this should be in effect for.
Yeah, I think the question is the remaining R&D that might have been capitalized for a project before 2025. Can you pick up?
I see. Okay. I believe that's the case, but let me get back to that individual and to be sure.
Okay. We're getting a lot of good polling. We're getting a lot of good questions from former McKonly and Asbury employees. So yeah, we can circle back on that one. So let's go to the next question or polling question here. Which type of business taxpayer are you? Cash basis, accrual basis, or other? Or we'll give everybody a few seconds here to answer that question. Okay, as we give everybody a few more seconds to answer that polling question, a quick question that came in here again, Zach, for you is, what is a PTE election?
Yeah, so PTE election is a pass-through entity tax election, and what that does is allow you to, if you're paying tax to, let's say you're filing a tax return in multiple states. Many of the states have allowed this, where you can make an election with the state to pay their taxes and have it deducted on the business return as a business expense, instead of it being paid by the business and passed through down to the individual, and then that would go through to your Schedule A and limited to the SALT cap deduction, which was 10%, now 40,000.
Right. Okay. All right. Thank you. Looks like the answer, we have a decent split here between cash basis and accrual basis, and then other basis here as to which type of business taxpayer are you. So we will keep moving here because we're already at 2:50 already. So we're closing in on the time. I will bring this thing home. Keep this quick as possible. Basically, what I'm going to talk about a little bit more is just kind of going through some things to consider going into 2026 as you're building your business plans and budgets and forecasts, and the idea of using performance indicators to manage the financial health of the business. So key performance indicators, let's just talk a little bit about that, just from the perspective of revenue growth. A couple of studies that were done by Harvard Business Review is that companies that use KPIs or key performance indicators typically grow their revenue between 10 to 20% faster than those without formal tracking mechanisms. Also, strategic alignment from Balanced Scorecard Institute noted that organizations with KPI scorecards align to strategic goals 42% more likely to achieve those long-term targets, and increase the employee accountability. The ClearPoint strategy was a study that said that teams with individual KPIs tied to outcomes that are 2.5 times more likely to hit their targets. And then finally, faster decision making. You can get out of KPIs. The Harvard Business Review also noted that companies using real-time dashboards make critical business decisions 20 to 35% faster, reducing time lost to lagging data and miscommunication. So one of the things that we like to talk about on our end is just making sure that you look at things from a historical perspective, but you also put in place the right performance measurements going into the future that will help you align your business and to grow your business into the future. So on to the next slide here, just talking about introduction to key performance indicators. What are they? They're quantitative metrics used to evaluate a company's financial health and performance. So it could be some basic performance indicators, such as things around cash flow management, collection of your receivables. It could also be tracking what is your gross profit percentages across different business lines, just to give you a better feel as to what the financial performance of the business is. Helps you track progress towards financial and strategic goals, and also commonly used by financial professionals, executives, and investors. So moving right along here, just to kind of keep things moving because we're kind of running out of time here. Importance of financial KPIs, why financial KPIs matter. Again, we just talked a little bit about improved decision making. It gives you the ability, as you're building your financial forecast and budgets into the future and building a good scorecard or KPI management, it helps you with identifying where certain lines of business are going, how they're performing. And if they're not performing, helps you quickly identify that to help you better make improved business decisions in regards to what you want to do with that line. Also helps you to align financial performance with strategic goals, enable early detection of issues, enhance communication with stakeholders, and support financial forecasting and budgeting. So again, the whole essence around the utilization of KPIs is to help you better forecast into the future what your business is going to do and help you better align with the strategic initiatives of what the business is trying to drive towards. Sometimes we mix up what KPIs are versus what measurements and metrics are. So what I want to talk about real quickly in this slide is just kind of giving you a feel of what the difference between the three are. So what we talk about when we talk about measurement is we're talking more about raw data analysis. That could be just looking at your balance sheet. It could be just quantifiable points of information, looking at revenue numbers, looking at number of invoices, what your inventory levels are. That is really more measurement, raw data. Metrics are really more centered around what is the calculation of a matter, what is the calculation of a ratio, what is the rate derived from a measurement. And this could be simple things like gross margin, looking at revenue, looking at what your cost of sales are. What we're trying to get with when we talk about key performance indicators is what are the strategically aligned important business metrics that you're really trying to drive towards and achieve to help establish what the future growth of the business is going to be. So maybe that's even a margin, maybe that's days sales outstanding, maybe that's return on equity. Maybe there are the things that you're really trying to drive towards in regards to positioning your business for growth into the future. So moving right along here to the next thing here is we talk about integrating KPIs into the 2026 business plan. So a couple things to keep in mind here is you want to make sure that those KPIs align with your strategic goals. Identifying what those strategic goals are for the business will help you then with what that KPI selection should be. And then from there, you will establish what target setting is going to be on those KPIs. And then from that target setting, that's where you kind of integrate that into your budget and forecast integration. You can also use these KPIs then to build some scenario analysis out, determining, you know, if the business does X revenue or if the business has X margins, what does that look like organizationally into the future of the organization? And then it helps align accountability and reporting across your different platforms within the business, across your different leaders and leadership within the business by identifying what key performance indicators for an organization should be. So it helps you with better accountability and just better financial reporting and tracking. So in conclusion then on the KPI side, you know, some of the takeaways are going to be, you know, financial KPIs are essential for measuring business and performance. Use the right mix of profitability, liquidity, and efficiency metrics that will help you with that. Context and trend analysis are critical. And then the final thing is KPIs support informed decision-making and strategic planning. And I know that was pretty quick digest in 5 minutes as we're running out of time here, but the one thing I will say is we will try to do a more in-depth analysis on KPIs with an upcoming blog post. That's for you, Hillary. Upcoming blog post on KPIs, and also looking to do maybe in 2026 another webinar on financial metrics and financial performance, financial health, and how to use KPIs. So there'll be a little bit more on that into the future. Let's get to that last polling question since we're down to 3 minutes here. That last polling question, what type of business entity tax return do you file? Is it 1040 Schedule C, partnership return, S corporation return, C corporation return? Maybe you're a 990, or maybe you're none of the above. If you're none of the above, I start to worry a little bit where exactly you're at, but we'll give everybody a few seconds to answer that question. All right, is everybody still answering that question? We'll give everybody another slow minute there, 30 seconds. Quick question that did come in here would be, are PTE elections the same idea as a composite K1?
No, so those are going to be something different, and many times, depending on the state, because each state's a little different, but there will be a PTE tax return and then another tax return that gets filed. And sometimes those are considered composite returns, but they are not the same thing. A composite return just is a group filing for all the individuals that are non-residents to that state.
Awesome. All right, Zach, thank you very much. Just look at the results here in the poll. It looks like 19% are filing Schedule Cs on their 1040, 37% are pass-through entities. C Corp is 11%, 990s are 13%. So this is 19% are none of the above. So hopefully they're just here to get CPE credit. But that's pretty good representation. So a couple key takeaways then. If you have not started planning for your year end, now you better start planning now. Now's the time to do it. Review all these financial operations now to ensure your financial statements are clear and concise for year-end tax preparation as well as third-party use. If you have any questions on that, Lindsay Young would love to talk to you. She can help you out with that. Work with your financial advisor, accountant, and tax professionals to evaluate all potential tax opportunities for 25, and also to how to position for 26 with the tax code and some of the extensions of the tax code. That would be a great leadway in for Zach. Zach would be a great guy to talk to there. And as you determine your 26 business plan and build initiatives around quality and measurement of your plan, more than happy to talk to you about how that budgeting, forecasting, business planning over the next 1 or 3 years. I'm happy to have a conversation with you there to help you out. So with that being said, there's our contact information. We just want to thank you today for joining us for today's webinar. If you have any further questions regarding today's presentation, feel free to reach out. Our team would be happy to assist. A recording of today's presentation will be posted on our website and social media sites in a few days. And for those of you requesting CPE and answered all the polling questions, that's the key, those certificates will be sent out within the next month. Just to give you everybody a couple of upcoming events. Collaborate is coming up next week. We will be hosting our 11th Leadership Conference, Collaborate, at the Eden Resort and Suites in Lancaster. Join our team and our community's business leaders, executives, and change makers on November 6th for a day of meaningful insight, actionable strategies, and fresh perspectives. I love it. I love it. Looking forward to it. And then just another update on a webinar, upcoming webinar, November 20th. Registration is also open for our next webinar, Owning the Change, the AEC Financial Professionals Blueprint for Successful 2026, taking place on November 20th at 2 p.m. Feel free to register right there. I heard these gentlemen that will be speaking at this webinar yesterday and did a great job speaking in front of some bankers. So I ask you to join that webinar. So with that being said, I want to thank everybody for joining and have a great rest of your day.